Welcome to this week's live ASX strategy session. Thank you for joining me. Great to have you with me. Lots of interesting things to talk about as we head into the new year. We're going to start off with that ASX 200, moving into the small ords, a few things to talk about there. Then we've also got the commodities. Want to have a look at gold, copper, oil, as well as uranium. And I've got a couple of stocks for you, a couple of really interesting stocks which are worth having a look and a think about. Now, as always, everything today is general commentary only. Nothing is personal, nothing's personally tailored to you. It's general commentary only. If you need personal advice, you've got to go and get that independently. That we've got all of that out of the way, I think it's time to get into that first chart. So let's start off with the ASX 200, and it's been interesting. It looks like we're getting that pullback. Looks like we're getting that pullback that we've spoken about over the last couple of weeks. Seems that that's now getting underway, and this really isn't that surprising. The ASX 200, it is at a key level. So just compress this chart a little bit. You can see these three previous high points up at around that 7,600 sort of mark. Now they go back to 2021 and into 2022. So three significant previous highs, and that's where the market has now found itself. So this is a pretty typical sort of place to get some sort of pullback. And as we've spoken about, we're also got the market quite stretched above these moving averages. So I've got the 50 and the 100-day moving averages. So when you combine those two factors, right up at near all-time highs, which is providing resistance, stretched above the moving averages, and that means that this is probably a pretty typical time for that pullback to kick in. And I think it really is important to note, though, that a pullback is not a bad thing. In fact, it's often a positive, because what a pullback does is a pullback lets a market consolidate the previous gains, and we have had some pretty significant previous gains, and then that consolidation can then lead on to onto another rally. And the thing to note with strong rallies is that rallies that don't consolidate, they often become quite unstable and unsustainable. And when that happens, this is when a rally will often fall back upon itself. And there's look, lots of examples. If we go back through time of seeing rallies that just take off, don't consolidate, and then they fall back. So a consolidation is often a positive thing. And it's often part of like healthy bullish phases. You get those advances, you get the consolidation, the advance, the consolidation, and then that potentially sets the market up for the next leg upwards. It's also interesting to have a look at. I want to put an indicator on this week. I'm going to use an RSI. You'll see me using this sometimes, particularly with the US market. I've been using it a bit, and it's also helped in some other markets we've looked at. I'm going to put it on for the ASX 200, and the reason for looking at this is just seeing how extended the rally got. I'll just compress this a little bit. So you can see where the RSI got to, up close to 80. This is a 14-period RSI. Often doesn't get that high. So it is a pretty stretched sort of level. So just looking at where the market is now, say in the next week or two, the market did pop up to a new high. I think it's unlikely the RSI would follow up with it, with the way that it's currently backing off and to the extreme that it got. So if we were to get a new high in the index, would probably end up with divergence on the RSI. So that would be another reason why we'd expect further consolidation to be coming in around these levels where we're currently at. So look, all that suggests to me that the best part of the gains are currently in place, at least for the time being. And now it's a matter of just waiting to see how potential consolidation plays out. What I want to do now, I want to do some Fibonacci analysis, and because that can be quite helpful in trying to work out where the market could come to. But first of all, I just want to clean up this chart a little bit. What I'm going to do, I'm going to take off this resistance band, which I've had on for I think a few months. I'm going to take that off. So it marks these previous high points from February 23 and July 23. Market didn't really pause when it got to them, carved straight through them. So I think they've lost their usefulness for now. So I'm going to take that off. And it's always important to just be looking at like what you have on your chart and remove things that no longer add value, rather than cluttering up a chart with a whole lot of indicators and lines on it. Try and keep your charts nice and clean. Try and keep them simple and focus on what really matters, not things that might have helped but didn't help, or did help but are no longer useful. So that one is now gone. Now let's do this Fibonacci stuff, Fibonacci analysis. So what I'm going to do, I'm going to measure from here, which is the November low, and go to the recent high. Now, if you're wondering why I'm using the November low and not the October low, is because when you do Fibonacci analysis, you're looking um, for one part of a move, for one leg of an upward move, not trying to just measure from one high to one low point to one high point. And so, for instance, so this October low, the complete move for that October low move, I think, finished in November, and then we had a consolidation. So that was, so if I was going to do Fibonacci analysis on this, I would have gone from the low to the high, and we can see it pull back to the upper end of the Fibonacci's. And it's quite discretionary when you do this. So that's why Fibonacci analysis is hard, and you get all sorts of different views. You got people measuring all sorts of different things. So, but for me, that was a complete move. It came back and then it rallied again. So now I'm measuring from the November low up to the recent high. And so if we were to get a Fibonacci pullback, you'd look at potentially the upper end of this range, which comes in just below 7,400. So that might seem like a fair way away at the moment, but it is interesting how often these Fibonacci's do provide balance to a chart, and you do find that over maybe several weeks, the market could find its way back down to this sort of region, which would also give these moving averages time to come and catch up, maybe get a return move to the moving averages. Just to give you an example from a previous time, just going back to into 2022. So we had a rally off the low, we had a consolidation. So then if I measure this next move up, had we done this at the time, and actually I probably did do this at the time, and um, and you say, look, the market could pull back, somewhere in this Fibonacci region. When we were only a few days in, that probably seemed a long way away. But look, over several weeks, it did make its way back there. So that's not to say this one's going to play out the same way and the market has to come back, but just gives you a guide as to what could happen over the next few weeks following such a strong rally, reaching resistance, the potential to come back into that Fibonacci zone, maybe over a few weeks. And I think that, so looking at that, you think, look, how do you play this type of situation then, where we're talking about, we've had a big run, but now we're talking about the possibility of a pullback. So firstly, there's no certainty that the market will come back to this Fibonacci region. That's just giving us a guide of something that could happen, help us build some sort of mental parameters around what could happen, what we could expect. But it's, of course, there's no certainty that will occur. So it's not a case of saying, well, look, okay, well, if that's going to happen, well, I'll sell, I'll take profits, I'll shut my portfolio down, and I'll buy back when we come back into the range, because that of course might not happen. So what I do, and what I do through, as you probably know, through the Motion Trader service, it's giving winning positions wide trailing stops. And the reason I do that is because if the market does pause briefly and then rally again, I'm still in the move. I'm able to stay on those stocks that are running. But then if we do get a deeper pullback and the market does, and the stocks in general come back towards this Fibonacci retracement, we get that bigger pullback, it gives myself a good chance of being able to see off that pullback and staying on a broader rally to what could be new highs and beyond. So the key is staying on those big rallies, and we do that using those wide trailing stops. What I don't want to do is sell now and try and buy back at a lower level. I think trying to get too clever and time the every little bit and piece of a move, it's just too hard. No one can do it consistently, and it's often costly because you end up selling something with which then continues to rally, and you miss out. And it's it's I think it's just best not to try and get too smart with the market, because the market is always going to be a step ahead of us. So we use those strategies like letting profits run, giving wide trailing stops, giving them room to move, and trying to stay on bigger advances. And that's how, in my experience, you get those big gains. And also trying to buy and sell all the time. You also just triggering capital gains tax events every time you lock in a profit. I think it's more efficient to try and ride those bigger trends. And as I've said for the last couple of weeks, I don't think the current situation is an asymmetric entry point just below this big overhead resistance. I don't think that's an asymmetric entry level for the ASX 200. But having said that, I'll still consider individual situations, and I'll show you a couple of examples of that a little bit later on. I'm essentially looking for stocks that are breaking higher and are rallying off their moving average, as opposed to ones that are like stretched above the moving averages. That's the sort of situation that I'd consider at the moment. Not really looking at those stocks which have already run hard. So as I say, I think the play here, focus on the long side, but try not to get overexcited after a strong move has already taken place. Pick your time, look for those asymmetric entry points. And and as I say, I've got a couple of examples where I've got stocks which are just breaking above moving averages and staying to move now, as opposed to ones which have already had a good go. So we'll get to that a little bit later. Now, look, if you're getting some value from this, or as always, please hit that like button and leave a comment. Just let me know what you're thinking, whether it's helping, what you like, what you'd like me to talk about, all that sort of stuff. Just hey, thanks for the video. Even it was really helpful, and look, it's good to hear that I am helping if I am actually doing so. And now I'm going to move on to the small ordinaries next, and then of course we've got the commodities and those stocks I want to talk about. But that wraps up today's free section. So if you're not a strategy session member and you'd like to get the rest of this, like to hear about the commodities and the small ordinaries and the two stocks I want to talk about, just click that link in the description section. You can sign up, become a strategy session member. It doesn't cost you very much. It's just like, it's like bringing a cup of coffee along to the session to thank me for putting it all together for you. It doesn't cost very much at all. It's a really low cost entry into the sort of world that I operate in. And now, look, having said all that, let's now move on to the small ordinaries. So